Hi, it's Chris Guldi with the Guldi Group at Keller Williams right here in Southern Maryland. We are starting to get a lot of questions regarding mortgages from people that are out there looking for homes. And so I'd like to do one of these videos with one of our mortgage partners in which we answer some of those questions. So if you've got some questions specific to a mortgage other than the one I'm going to answer today, then please go ahead and drop me an email, send us a text, smoke signal, whatever the case may be, how you want to get it to us, and we'll do that for that upcoming video. But today's question is actually one that came up while training a new agent here recently, and that question is, what actually is involved in a debt-to-income ratio? So if you've been researching mortgages at all, you've probably seen the term DTI, and that is debt-to-income ratio, and that is how much of your money are you spending on your bills. So what goes into that? What are they looking at? So they're really looking mostly at your fixed expenses. Your current mortgage payment or what your new mortgage payment will be factored into that. The insurance cost on that mortgage is going to be factored in. The taxes on that property or your current property, if they're looking at your current expenses, are going to be factored in. If it's a rental, if you have a rental currently, they are going to be using the rent as part of your fixed expenses that are going to factor into your debt to income ratio. In addition to that, we're going to see stuff like student loan payments, car payments. These fixed expenses, those are part of your debt to income ratio. Some of the things that don't get factored into that are things that are variable, that fluctuate based on the current cost of living or just what you buy. So gas in your car, that's not something they're going to factor in. They're not going to factor in your groceries expenses, your utility bills, because those vary. So those things aren't going to be factored in. They're really looking at your fixed expenses. They are also going to look at your credit card payments. So if you're carrying a debt load on your credit card and you have a payment for that, that tends to stay pretty much close to the same amount of payment. If you're showing a history of making that minimum payment, then they are going to factor in that credit card payment into your debt to income ratio, and it's going to impact how much house you can afford. If you own a rental property, then they're going to factor in the mortgage payment on that. And if you've had the rental property long enough, generally long enough that you've paid taxes on the income from the rental property, then they'll factor in the income from the rental property to offset that. But they do factor in the mortgage payments on any rental properties you own as well. So that's what goes into the debt to income ratio. It's very important when you're applying for a mortgage. They look really hard at that. Different types of loans have a different ratio that they allow you to have. And then on top of that, the lenders may have something more restrictive than what FHA or traditional Fannie or Freddie loan is going to have as standards and guidelines on that. So if you have any other questions about mortgage, like I said, I'm getting ready to set up one of these recordings with one of our mortgage partners specifically to answer those questions. So send them on into us and we'll get that recording done for you and out to you. Have a great day. Thanks a lot for watching.